looking to renovate your home or a new home that you're interested in buying but don't want to spend any of your own funds? If so, stay tuned. A renovation loan is designed to combine a home loan either for refinance or purchase, but also add the rehab cost to your loan. Therefore, you would end up with just one loan moving forward. The luxury of this loan is that there are no rehab costs that are coming out of your pocket. But also very cool about this loan is that you are using the after rehab value. We'll give a little bit of examples below. You can put down as little as 3%. So for example, if you were to finance a property at $450,000 where you needed $50,000 in rehab, hence financing a total of $500,000, you would put down a minimum of 3%, which is $15,000. Now, this is subject to qualification, so please inquire. The property does not need to be livable or habitable based on your county or city regulations. However, you cannot find a property that you wish to tear down to the foundation and rebuild. So there is some more information about that, but you have roughly 15 months from the time that your loan closes, be it a refinance or a purchase, to complete the rehab of your project. So that does mean that if you have open permits or anything like that that need to be finalized, those need to be addressed prior to that time frame. The other question that comes up is, can you extend that time frame? The answer to that question is yes, and there will likely be some costs, but call for more information. The very cool thing about this loan is that you do not have to refinance your loan once your rehab is complete. The benefit of this is it prevents you from being exposed to current market rates. So for example, if you were to get a loan at 5% and by the time your rehab is done, you were forced to refinance or do what's called a takeout loan, like some construction loans have, and the market rate may be 7%, that could hurt, right? So the benefit here is that it is a true one-time close, therefore protecting you in the market should the rates go worse. Now, with that being said, let's flip-flop this a little bit. Let's say that you get a current rate at 7%, and when you're done, the rate is at 5%. Being that it was a one-time close, are you exposed to keeping that 7% rate? The answer to that question is no. You could take advantage of the lower rate, but again, like I mentioned before, you'd have to inquire for more information. If you like this video, check this video out I just did. It is also quite educational. So, if you are interested in rehabbing with no out-of-pocket and want more information, call us today.